In today's fast-paced world, banks are on the brink of a paradigm shift. Artificial intelligence is a catalyst for redefining strategy, culture, and operations for today's modern bank. KPMG's research reveals that while many financial institutions see AI as critical to their future, only a small fraction report achieving measurable returns on their AI transformation as investment grows. And 70% report significant pressure to show immediate return on investment. With AI, banks can enhance customer experiences, streamline operations, and drive sustainable growth. From fraud prevention and policy review to personalized banking, AI is transforming every aspect of the financial ecosystem. How do you become the intelligent bank of the future? You can with AI. You can with KPMG. Discover the blueprint of the future bank at kpmg.com/intelligent banking. The energy transition isn't just a shift, it's a transformation, one that demands new forms of resilience, adaptability, and value creation. AI is no longer just a tool, it's becoming foundational. It's enabling energy companies to rethink how energy is generated, distributed, and optimized in real time. The goal? Drive efficiency, reduce waste, and create systems that are responsive, intelligent, and sustainable. Investment is following intent. Over 3/4 of energy leaders are scaling up AI spend, with nearly 2/3 increasing it by more than 10%. Why? Because AI is accelerating growth in automation, predictive analytics, and intelligent products, building real business value. As the industry navigates the trilemma of security, sustainability, and affordability, the question is no longer if AI plays a role, but how it enables energy organizations to not only optimize, but evolve. How do you design an organization that can lead, not just optimize? You can with AI. You can with KPMG. Discover the blueprint for energy organizations at kpmg.com/intelligent energy. Imagine a world where public services operate seamlessly, tailored to the unique needs of every citizen. At the heart of it lies intelligent government, powered by artificial intelligence. The public sector is transforming, harnessing the capabilities of AI technology. KPMG's latest report, Intelligent Government, a blueprint for creating citizen-centric value through AI-driven transformation, is your guide to navigating this opportunity. 79% of public sector leaders believe AI will give governments a strategic advantage, yet only 12% have fully embedded it into their organizations. The gap is clear, but the potential is even clearer. From improving citizen experiences to streamlining service delivery, governments around the globe are leveraging AI to support real-time decision-making, predictive analytics, and life event services. How can government agencies embed AI and lead by example? You can with AI. You can with KPMG. Discover the blueprint of AI transformation for government at kpmg.com/intelligent government.
The 11th edition of KPMG's CEO Outlook is out now, with insights showing global CEOs are positive if cautious about the future. Here are 5 key headlines from the survey. First up, AI remains among CEOs' top investment priorities, with 69% planning to allocate between 10 and 20% of their budgets to the technology. Meanwhile, 92% of CEOs who responded said they plan to increase the overall headcount in their workforce over the next 3 years. These ideas converge when it comes to AI talent, with 70% of CEOs concerned about competition for roles and 77% highlighting workforce upskilling as a challenge. This comes at a time when CEO confidence in the global economy has dipped to 68%, its lowest level since 2021. However, confidence in their own organizations is strong, with 79% of CEOs optimistic about their company's prospects. And there's good news for net zero targets, with 61% of CEOs expressing confidence in hitting their goals by 2030, a significant increase from 51% in 2024. Learn more about this year's results by searching KPMG CEO Outlook 2025.
In today's fast-paced world, banks are on the brink of a paradigm shift. Artificial intelligence is a catalyst for redefining strategy, culture, and operations for today's modern bank. KPMG's research reveals that while many financial institutions see AI as critical to their future, only a small fraction report achieving measurable returns on their AI transformation as investment grows. And 70% report significant pressure to show immediate return on investment. With AI, banks can enhance customer experiences, streamline operations, and drive sustainable growth. From fraud prevention and policy review to personalized banking, AI is transforming every aspect of the financial ecosystem. How do you become the intelligent bank of the future? You can with AI. You can with K.
of CEOs concerned about competition for roles, and 77% highlighting workforce upskilling as a challenge. This comes at a time when CEO confidence in the global economy has dipped to 68%, its lowest level since 2021. However, confidence in their own organizations is strong, with 79% of CEOs optimistic about their company's prospects. And there's good news for net zero targets, with 61% of CEOs expressing confidence in hitting their goals by 2030, a significant increase from 51% in 2024. Learn more about this year's results by searching KPMG CEO Outlook 2025.
In today's fast-paced world, banks are on the brink of a paradigm shift. Artificial intelligence is a catalyst for redefining strategy, culture, and operations for today's modern bank. KPMG's research reveals that while many financial institutions see AI as critical to their future, only a small fraction report achieving measurable returns on their AI transformation as investment grows. And 70% report significant pressure to show immediate return on investment. With AI, banks can enhance customer experiences, streamline operations, and drive sustainable growth. From fraud prevention and policy review to personalized banking, AI is transforming every aspect of the financial ecosystem. How do you become the intelligent bank of the future? You can with AI. You can with KPMG. Discover the blueprint of the future bank at kpmg.com/intelligent banking. The energy transition isn't just a shift, it's a transformation, one that demands new forms of resilience, adaptability, and value creation. AI is no longer just a tool, it's becoming foundational. It's enabling energy companies to rethink how energy is generated, distributed, and optimized in real time. The goal? Drive efficiency, reduce waste, and create systems that are responsive, intelligent, and sustainable. Investment is following intent. Over 3/4 of energy leaders are scaling up AI spend, with nearly 2/3 increasing it by more than 10%. Why? Because AI is accelerating growth in automation, predictive analytics, and intelligent products, building real business value. As the industry navigates the trilemma of security, sustainability, and affordability, the question is no longer if AI plays a role, but how it enables energy organizations to not only optimize, but evolve. How do you design an organization that can lead, not just optimize? You can with AI. You can with KPMG. Discover the blueprint for energy organizations at kpmg.com/intelligent energy. Imagine a world where public services operate seamlessly, tailored to the unique needs of.
The 11th edition of KPMG's CEO Outlook is out now, with insights showing global CEOs are positive if cautious about the future. Here are 5 key headlines from the survey. First up, AI remains among CEOs' top investment priorities, with 69% planning to allocate between 10 and 20% of their budgets to the technology. Meanwhile, 92% of CEOs who responded said they plan to increase the overall headcount in their workforce over the next 3 years. These ideas converge when it comes to AI talent, with 70% of CEOs concerned about competition for roles, and 77% highlighting workforce upskilling as a challenge. This comes at a time when CEO confidence in the global economy has dipped to 68%, its lowest level since 2021. However, confidence in their own organizations is strong, with 79% of CEOs optimistic about their company's prospects. And there's good news for net zero targets, with 61% of CEOs expressing confidence in hitting their goals by 2030, a significant increase from 51% in 2024. Learn more about this year's results by searching KPMG CEO Outlook 2025.
In today's fast-paced world, banks are on the brink of a paradigm shift. Artificial intelligence is a catalyst for redefining strategy, culture, and operations for today's modern bank. KPMG's research reveals that while many financial institutions see AI as critical to their future, only a small fraction report achieving measurable returns on their AI transformation as investment grows. And 70% report significant pressure to show immediate return on investment. With AI, banks can enhance customer experiences, streamline operations, and drive sustainable growth. From fraud prevention and policy review to personalized banking, AI is transforming every aspect of the financial ecosystem. How do you become the intelligent bank of the future? You can with AI. You can with KPMG. Discover the blueprint of the future bank at kpmg.com/intelligentbanking. The energy transition isn't just a shift, it's a transformation, one that demands new forms of resilience, adaptability, and value creation. AI is no longer just a tool, it's becoming foundational. It's enabling energy companies to rethink how energy is generated, distributed, and optimized in real time. The goal? Drive efficiency, reduce waste, and create systems that are responsive, intelligent, and sustainable. Investment is following intent. Over three-quarters of energy leaders are scaling up AI spend, with nearly two-thirds increasing it by more than 10%. Why? Because AI is accelerating growth in automation, predictive analytics, and intelligent products, building real business value. As the industry navigates the trilemma of security, sustainability, and affordability, the question is no longer if AI plays a role, but how it enables energy organizations to not only optimize, but evolve. How do you design an organization that can lead, not just optimize? You can with AI. You can with KPMG. Discover the blueprint for energy organizations at kpmg.com/intelligent energy. Imagine a world where public services operate seamlessly, tailored to the unique needs of every citizen. At the heart of it lies intelligent government, powered by artificial intelligence. The public sector is transforming, harnessing the capabilities of AI technology. KPMG's latest report, Intelligent Government, a blueprint for creating citizen-centric value through AI-driven transformation, to navigating this opportunity. 79% of public sector leaders believe AI will give governments a strategic advantage, yet only 12% have fully embedded it into their organizations. The gap is clear, but the potential is even clearer. From improving citizen experiences to streamlining service delivery, governments around the globe are leveraging AI to support real-time decision-making, predictive analytics, and life event services. How can government agencies embed AI and lead by example? You can with AI, you can with KPMG. Discover the blueprint of AI transformation for government at kpmg.com/intelligent government.
The 11th edition of KPMG's CEO Outlook is out now, with insights showing global CEOs are positive if cautious about the future. Here are 5 key headlines from the survey. First up, AI remains among CEOs' top investment priorities, with 69% planning to allocate between 10 and 20% of their budgets to the technology. Meanwhile, 92% of CEOs who responded said they plan to increase the overall headcount in their workforce over the next 3 years. These ideas converge when it comes to AI talent, with 70% of CEOs concerned about competition for roles, and 77% highlighting workforce upskilling as a challenge. This comes at a time when CEO confidence in the global economy has dipped to 68%, its lowest level since 2021. However, confidence in their own organizations is strong, with 79% of CEOs optimistic about their company's prospects. And there's good news for net zero targets, with 61% of CEOs expressing confidence in hitting their goals by 2030, a significant increase from 51% in 2024. Learn more about this year's results by searching KPMG CEO Outlook 2025.
In today's fast-paced world, banks are on the brink of a paradigm shift. Artificial intelligence is a catalyst for redefining strategy, culture, and operations for today's modern bank. KPMG's research reveals that while many financial institutions see AI as critical to their future, only a small fraction report achieving measurable returns on their AI transformation as investment grows. And 70% report significant pressure to show immediate return on investment. With AI, banks can enhance customer experiences, streamline operations, and drive sustainable growth. From fraud prevention and policy review to personalized banking, AI is transforming every aspect of the financial ecosystem. How do you become the intelligent bank of the future? You can with AI. You can with KPMG. Discover the blueprint of the future bank at kpmg.com/intelligent banking. The energy transition isn't just a shift, it's a transformation, one that demands new forms of resilience, adaptability, and value creation. AI is no longer just a tool, it's becoming foundational. It's enabling energy companies to rethink how energy is generated, distributed, and optimized in real time. The goal? Drive efficiency, reduce waste, and create systems that are responsive, intelligent, and sustainable. Investment is following intent. Over 3/4 of energy leaders are scaling up AI spend, with nearly 2/3 increasing it by more than 10%. Why? Because AI is accelerating growth in automation, predictive analytics, and intelligent products, building real business value. As the industry navigates the trilemma of security, sustainability, and affordability, the question is no longer if AI plays a role, but how it enables energy organizations to not only optimize, but evolve. How do you design an organization that can lead, not just optimize? You can with AI. You can. Discover the blueprint for energy organizations at kpmg.com/intelligent energy. Imagine a world where public services operate seamlessly, tailored to the unique needs of every citizen. At the heart of it lies intelligent government, powered by artificial intelligence. The public sector is transforming, harnessing the capabilities of AI technology. KPMG's latest report, Intelligent Government, a blueprint for creating citizen-centric value through AI-driven transformation, is your guide to navigating this opportunity. 79% of public sector leaders believe AI will give governments a strategic advantage, yet only 12% have fully embedded it into their organizations. The gap is clear, but the potential is even clearer. From improving citizen experiences to streamlining service delivery, governments around the globe are leveraging AI to support real-time decision-making, predictive analytics, and life event services. How can government agencies embed AI and lead by example? You can with AI. You can with KPMG. Discover the blueprint of AI transformation for government at kpmg.com/intelligent government.
The 11th edition of KPMG's CEO Outlook is out now, with insights showing global CEOs are positive if cautious about the future. Here are 5 key headlines from the survey. First up, AI remains among CEOs' top investment priorities, with 69% planning to allocate between 10 and 20% of their budgets to the technology. Meanwhile, 92% of CEOs who responded said they plan to increase the overall headcount in their workforce over the next 3 years. These ideas converge when it comes to AI talent, with 70% of CEOs concerned about competition for roles, and 77% highlighting workforce upskilling as a challenge. This comes at a time when CEO confidence in the global economy has dipped to 68%, its lowest level since 2021. However, confidence in their own organizations is strong, with 79% of CEOs optimistic about their company's prospects. And there's good news for net zero targets, with 61% of CEOs expressing confidence in hitting their goals by 2030, a significant increase from 51% in 2024. Learn more about this year's results by searching KPMG CEO Outlook 2025.
Generator.
In today's fast-paced world, banks are on the brink of a paradigm shift. Artificial intelligence is a catalyst for redefining strategy, culture, and operations for today's modern bank. KPMG's research reveals that while many financial institutions see AI as critical to their future, only a small fraction report achieving measurable returns on their AI transformation as investment grows. And 70% report significant pressure to show immediate return on investment. With AI, banks can enhance customer experiences, streamline operations, and drive sustainable growth. From fraud prevention and policy review to personalized banking, AI is transforming every aspect of the financial ecosystem. How do you become the intelligent bank of the future? You can with AI. You can with KPMG. Discover the blueprint of the future bank at kpmg.com/intelligentbanking. The energy transition isn't just a shift, it's a transformation, one that demands new forms of resilience, adaptability, and value creation. AI is no longer just a tool, it's becoming foundational. It's enabling energy companies to rethink how energy is generated, distributed, and optimized in real time. The goal? Drive efficiency, reduce waste, and create systems that are responsive, intelligent, and sustainable. Investment is following intent. Over 3/4 of energy leaders are scaling up AI spend, with nearly 2/3 increasing it by more than 10%. Why? Because AI is accelerating growth in automation, predictive analytics, and intelligent products, building real business value. As the industry navigates the trilemma of security, sustainability, and affordability, the question is no longer, if AI plays a role, but how it enables energy organizations to not only optimize, but evolve. How do you design an organization?
Good morning. Good morning. I hope we are all well and that you're enjoying the breakfast. I can see some of us still grabbing something to eat, so that can continue as we go into the session. So I'd like to start, ladies and gentlemen, by inviting you to this session today. My name is Dr. Alex Mbai. I'm a partner at KPMG, and I also lead our clients and markets initiative here in East Africa. So I would like to give you a very warm welcome. Thank you for sparing your time this morning, rising up early to come and join us today. We are very pleased for you joining us this morning. So we are here to launch the 2025 KPMG Africa CEO Outlook report based on a survey that we have done in the market. And we welcome you to participate and give us your contributions, even as we roll out the insights that we have gathered from our survey in the market. So your insights and contributions will be very important. We are in a very dynamic environment here in East Africa and indeed across Africa, with changes happening very, very rapidly. You have seen what is happening in Tanzania, for example, and many other changes that are happening across the continent. So these changes, I think, continue to give us opportunities in this business environment, and you as CEOs have a very practical and first-hand experience in the market. So we'll be looking forward to listen to you as you give us the insights and what you're seeing in the market. So this is the second survey. We did this first in 2024. And so there's a lot of evolvement from last year. We'd like to see what is new in this year and going forward, and what is the future outlook. Our speakers this morning, we have got a panel who will roll out the report and give out the insights that we have seen, and we'll then welcome your contributions as we go along. So welcome, and we are glad to have you with us this morning. Without further ado, I would like to invite our CEO and senior partner, Benson Dungu, CEO for KPMG East Africa, to make his opening remarks. Let's welcome Benson.
Thank you very much, Alex. Distinguished guests, clients, colleagues from across the Africa continent, members of the fourth estate, I believe we have some in the room. Good morning. Good morning. It's a great delight, as Alex has said, to be standing in front of you this morning to launch the second edition of the Africa CEO Outlook survey. This survey is anchored on the KPMG Global CEO Outlook survey, which is in its 11th year. So you can imagine the level of detail and insights that come out of the degree of engagement with CEOs from across the globe. That survey covers about 1,300 plus CEOs from some of the largest corporate organizations in the world, from across 11 regions. And those regions include Africa. So I'm very proud that we have, in the second year in a row, been able to launch this as One Africa, capturing insights from our own CEOs across the largest corporates in Africa. Out of the 1,300, 10% of those CEOs are from Africa. So you'll be listening to the insights comparatively at global level, Africa level, and we will have after these insights that capture the sub-regional level, East Africa, West Africa, and Southern Africa. So we are launching it from Nairobi. Last year, we launched it from Southern Africa. And I want to appreciate you being able to be with us this morning. I know it's even earlier in Southern Africa and West Africa, but we do have people who are tuned into this. So I very much acknowledge and appreciate your presence. So thank you very much for making the time. Because I've been asked to make some remarks, I will just stick to remarks. And I'll share my observations from the results that have come out of the survey. And I'm here you hear details of those themes because they must be consistent with what we're going to listen to. One, we have become accustomed over the years in leading through volatility. I think as CEOs, there is a clear demonstration of a resilience. The geopolitics space, in particular, over the last 12 months or so, has become increasingly volatile. And you'll have experienced it in your day-to-day. That links to the economic uncertainty that you see across the globe. So supply chain disruptions, whether it is trade, the impact has been immense. But what is good about it, the perception of the global CEOs, Africa CEOs, is that there still remains opportunity in there with those challenges. And that is a positive, and that's what I take from this feedback that has come through. So we must lead through the opportunity that comes with the volatility and the uncertainty. I think some years back, people used to say it's a new normal. It's never the new normal. It has always been. I don't remember speaking to any CEO even before I became a CEO myself who had never experienced challenges and volatility in whatever manner, in whatever form. But in this age, I think that is what we need to be aware of. Linked to that, observation that has come through is that there's a greater confidence in the industries that the CEOs who have been interviewed have for their own corporates. They see more opportunities. Even when they see some depressed global economic growth, they see opportunities. A positive. AI is a big thing. And more specifically, when you think about agentic AI, so technology and AI is critical in the way CEOs are driving their strategy and is being incorporated as part of their strategic focus. And for this, the most crucial thing is last year, when we spoke to the CEOs, when they gave feedback, whereas they were keen on AI, they were not expecting return on that investment they were going to make earlier than the 3 years. So they were looking at 3 to 5 years. This time they're saying, no, it is immediate. First year to third year, they expect returns because it is about integrating AI and enabling the systems, processes, people that you have to do much better. So we are going to hear what specifically they have come out and the degree of confidence and expectations and what they are doing, what you are doing, because I know majority of you, not all of you, have for the last couple of years been navigating through this new phenomenon. And indeed, you cannot afford to ignore agentic AI in particular, because it will shape the how, the what, and the level of attention that you need to make on what you deliver to your customers, because it's shaping both ways. Of course, there are concerns that come with it. There's the ethical AI, the trusted AI, and the integrity of data, all that, and regulation or lack of it. So there's a lot to discuss and digest, internalize with regard to AI, but it is the way to go. And CEOs are committing significant investments in pursuing and embedding AI in their businesses. Linked to that is the workforce and the talent. The war on talent for AI is going to become more intense because it is not there. All of us are learning AI and how it's impacting our businesses. So I think the message from the CEOs from across board, globally and across the Africa region, is that you need to retrain your people. You will need to redesign the roles within your organization. You may need to reshape your processes. So reskilling is also very important. And that does not only relate to your staff. Your staff includes ourselves. So we must start skilling from the top. Otherwise, you lose it. You are the owner of the transformation that comes with AI. If you don't lead it with your management team, your staff will not. And then you lose your competitiveness. I think that's important to note as well, and we're going to hear details about that. The last one is that I can speak about is ESG. I think irrespective of what we've had from some different quarters, ESG is very much alive. It is not dead. The CEOs have affirmed, and they're even more optimistic about the gains they're making in ESG, especially the E and the S. And they are very confident, majority of them, that they are on track to meet their 2030 net zero targets. 61% of them, I think I can mention that, did express confidence on their commitment compared to 51% last year. So which tells you that whereas there may be some concerns raised, CEOs are very focused because they understand the centrality of focusing on ESG in ensuring the sustainability of their businesses. So there's a lot that we have for you this morning. So we will be getting into the detail of it, but from my reading of the feedback, those are the key themes, and I'm sure they'll be consistent with what we'll be listening to this morning. And I invite all of us to become active as we start to engage. But before we get into the detail, allow me to invite a special friend and a colleague, Ignatius Sehule, who is also my boss, the Africa CEO, KPMG in Africa. Welcome, Ignatius. The floor is yours.
Good morning, ladies and gentlemen, and our distinguished guests this morning. And Benson says he's inviting his boss on the stage, but he knows he and all the other people at KPMG are my bosses. I do what they tell me. As an example, they told me to be here today, and I'm here. So you can just see who the boss is. I think the outlook, the CEO outlook is, as Benson has indicated, is the second year running. And we have every intention to keep it running every year going forward. And the themes, as Benson has indicated, have been picked up. I think all what I can just say to bring a different perspective is that, as you know, as CEOs, the complexity of what you deal with on a daily basis. It's just getting worse and worse every day. And it actually comes through in the survey. Another thing is stakeholder expectations. And, gone are the days when the stakeholders were just your shareholders and your loan providers. And it's actually every man in the street is now your stakeholder and has got expectations. And they are not shy about putting those expectations on the table. So it becomes a much more complex way of doing business, the right way though, but a much more complex way of doing business. I think none of our organizations, in particular in the continent, would want to go ahead and do business in a way that is harming communities and environments. And we take that responsibilities as CEOs very, very seriously. And another thing is about long-term value creations, which the stakeholders, some of the stakeholders might not appreciate, because as human beings, we tend to have the instant gratification kind of mindset, in particular, the younger generation. But as CEOs, it's upon us to ensure that we manage the businesses for the long-term value. And that might not sit well with the short-termism of what other stakeholders might be looking at. Another thing that has always been there, but is taking a different turn in terms of complexity, is the geopolitics. And in my view, I'd like to see it as the complexity coming in two ways. One is that politically, the rest of the world has its own agenda. That's always been there. But I think we are also, as a continent, beginning to have our own agenda. And the two don't sit very well side by side. Because the one, it's about making sure that you keep Africa poor and extract all the minerals and the riches and bring it back as a very costly product. We are moving to a point where we say, no, but these minerals are ours. We need to start beneficiating and benefiting our people from these. And this is a complexity that's, in my view, still at the beginning, but it's going to continue and it's going to make doing business more and more complex. And in that journey, I would urge CEOs not to forget our governments, because we need to take them along. Whether they realize it or not, they need our help. And they also need to have the confidence that when they adopt the posture that benefits the locals, they will have our support as corporations. Business and public sector have to work together if we are to succeed. Now, with that, one of the things that is at the forefront of CEOs is ensuring that our businesses have resilience in the midst of all these geopolitical situations. That resilience is key. And there's many ways, and Benson was talking about AI. It's one of those that you build in resilience in your business. And one of the heartwarming things that I picked up in the survey is that in general, African CEOs are looking at spending at least 20% of their budgets on AI. The global norm is about 14%. We're spending a bit more. Now, that tells me that one, I think this is the one particular race that we're not going to be left behind in. That tells me that Africa will not wake up one day and the whole world has disappeared into the distance as far as AI is concerned. But also, when you look at the agenda of every CEO, the AI is center of all the discussions. So that gives me a bit of satisfaction in that regard. Now, being in Africa where unemployment is a problem, there's always this thing that says, but this AI, is it not going to leave our population even much more unemployed than before? The unemployment rate will just skyrocket. But when you talk to the CEOs and when you look at the ground as to what is happening, is actually the opposite. The most important thing is about skills. So retraining and making sure that the people have got the right skills to deal with AI is very important. And therefore, with that understanding, I mean, I was worried that I would see CEOs saying that, listen, we're going to start employing less, but no, they're employing more, but it's the kind of skills that you're looking at that is different. What is key, though, is that CEOs are also re-looking at the entry level or the menial kind of jobs. Those will go away, because those manual, repetitive, and this is not a new thing. Automation has already started that. This is just taking it at a higher level. But therefore, we need, therefore, education is key, getting the relevant skills. So we urge, and I know a lot of it business will do on its own because you're not going to wait for governments, but we need to be interacting with universities and governments and with the Department of Education, even at schools, to change the syllabuses and look at different ways of how we educate our masses in Africa. It's not about not employing anymore, but it's about looking for different skills, and we've got to take the system with. And that's why it's always important for private sector to engage with government. And that partnership, sometimes we don't like it, but it's key. We can do without. And the other issue that Benson spoke about was the ESG. My observation of what warmed my heart is that CEOs are not seeing ESG as one other thing to do, but they're looking at ESG as something that needs to be integrated into the core strategy. So this is how you do business. Not you do business, and by the way, don't forget this ESG. No. Our way of doing business is taking into account ESG. When you think of doing things on every project and every process that you look at, ESG is part of it. It's not something that you do on your side, which is actually quite important. My last and most exciting observation, and if you look in East Africa, I think it's more than a 20% drop of the confidence that Africa CEOs have on the global markets. It's been a significant drop, but the confidence that Africa CEOs have on our own markets in the continent, that has gone up, and it's heartwarming. But even more important, the CEOs are even much more upbeat about the opportunities that they have in their own organizations, which is very key. And that talks to Africa development, and it talks to issues of employment, as I've said. So to have confidence in your own markets and even more confidence in the prospects of your own organization, I think for me, when I read the survey, is the most positive thing that we should take as to heart and ensure that we spread the word. to boost confidence even more. All what is left of us as CEO is the good word, implement. Thank you very much.
Good morning, everybody. Good morning once again. Now we not had breakfast. We sound a little soft this morning. I believe I have met the great majority of the people in the room. For those who we have not interacted, my name is Gerald Kasimu. I am the head of advisory for KPMG in Africa. And I will be taking the opportunity this morning to take you through, in a little more detail, the outcomes of the CEO Outlook survey. My previous speakers have mentioned that this is in second year running in issuing the report for the CEO Outlook for Africa. But it is actually 11 years running as a global CEO Outlook report. Many of the East Africa CEOs represented will be aware that over the course of the last 6 or 7 years, we've had the opportunity to delve into the highlights of the report. I'm going to be looking at about 4 key themes in this analysis. As you're aware, we have generally conducted the survey over the course of the last few years across the globe. We cover about 1,350 CEOs, some of the largest organizations across the globe. In Africa, we had about 130 organizations represented, and they cover all the key sectors of the economy. So the views are quite representative of the perspectives that our chief executives in the region have in comparison to their global counterparts. Let's start with the first theme, which is the economic outlook. And I think to a certain extent, Ignatius has alluded to what we see in the report. As you can see on screen, the great majority of CEOs, in fact, almost 80%, are confident about the growth prospects of their own organization. So we see a level of confidence and optimism across Africa, in line with global. We also see that about 53% of the Africa CEOs are expressing confidence in the growth of the global economy. And more importantly, an even bigger sense of optimism and confidence in our own local market, which is really, really important. What does it mean? It really signals renewed assurance in our business leaders' ability to drive performance and adapt to changing market conditions. If we then move further and take a look at the what are some of the pressures and challenges that our CEOs are grappling with in spite of the optimism. So on screen, you will see there are many challenges, but the top 3 that come through relate to integration of AI into organization processes and systems. So a very important theme that is coming through. Of course, regulatory pressures remain topical issues, as we have seen in previous years. And then lastly, integration of AI into workforce roles and responsibilities within the organization. And this cannot be overemphasized, and you will see that thread coming through in most of the commentaries that are coming through from the CEOs, because effectively, to implement AI, you got to have the right capabilities and skills within the organization. And by the way, not just with a young workforce, but everybody across the organization needs to have that, among many other challenges that our CEOs are grappling with. If you then move on and take a look at, in terms of the investments to mitigate the challenges that we see, you will see that there is an emphasis, given the challenges that we have seen on the previous page, on cybersecurity and digital risk resilience. And for the last 6 or 7 years, when I have stood on the podium and shared the results, cyber has been one of the top 3 focus areas of, for chief executives. We also see AI integration into operations and workflow, and many organizations are at different levels of adoption and integration. And thirdly, investing in solutions and technology innovation for business expansion. So Africa CEOs have sought to mitigate these pressing challenges to a large extent by increasing investments into cyber, AI, amongst some of the other items that you see on screen. Now, when asked about the outlook on earnings across Africa, you will see that there is a clustering in terms of earnings outlook, somewhere in the region of between 2.5% to 5%, with 44% of our CEOs having a level of confidence, and then another 41% or so expecting less than 2.5% in growth in earnings over the course of the next 3 years. Now, of course, the role of the CEO is changing, particularly because of the pressures and the opportunities that you see coming through. And effectively, the role is being redefined to a great extent. So CEOs are being expected to act with greater agility in fast decision-making under pressure. We see a broader expectation in understanding and adopting digital and technology and being literate about technology and AI to a greater extent. And beyond that, AI literacy and understanding. But the rest of the ability to communicate effectively, the ability to drive change and cash flow transformation, foresight and scenario planning, those remain as core expectations of capabilities that our CEOs continue to build and focus on. Again, as you can see on screen, we see CEOs feeling far more responsible for the longer term prosperity of their organizations. Today's CEOs are expected to be far more strategic, beyond just strategic thinking, the ability to embrace digital AI literacy, lead transformation, and demonstrate agility in decision-making. So you can see about half of our CEOs in Africa and across the globe, they see that their role is changing with new expectations, either moderately or high. Beyond just organic growth, we see the level of confidence now being reflected in CEOs' appetite for acquisitions. It clearly points to a stronger appetite for partnerships and expansion, effectively to scale businesses and increase capability across a range of areas. So you can see on screen there is increasing appetite for investments and mergers, acquisitions, and so on. If I then look further into some of the trends to watch that may impact the organization, and there's several. Regulatory demands within Africa remains a topical issue. The AI workforce readiness and upskilling, and Benson started to speak to that at the beginning of his presentation. Successful integration of AI into business processes, amongst other factors like the geopolitics, which Ignatius has summarized, the cost of technology and infrastructure, and especially in Africa, massive. Whether you're looking at cost of data centers, GPUs, the devices, the hardware that we require, and just really getting the data ready to be able to capitalize on the changing environment. What are some of the other factors and trends that could negatively impact success? And we can see a few trends that our CEOs are paying particular attention to. Cybercrime and cybersecurity. 76% of our CEOs see that as a major issue of concern that they need to pay attention to. We also see supply chain considerations. We see the issue of misinformation, and there's a lot of that in current times, given the changes in technology and the perversity of it. And climate change, natural disasters, and extreme weather also becoming some of the factors that CEOs are paying attention to in managing their businesses. Let's look a little more closely at technology and AI. And Ignatius made mention of the investments that are going into AI over the next 12 months. And you'll see across Africa, at least 1 in 2 CEOs are spending between 10 and 20% of their budget in investments in AI. Compared to their global counterparts, where 7 in 10 are spending 20%. At KPMG, I was just looking at some of our investments globally, and 50% of our investment budget is going into AI. 50% of our global investment budget into AI. So you can imagine the implications on business models, and that is driven by the trends that we see similar to our counterparts in the industry. So these are investments, whether it's in infrastructure, access to power, upgrading and updating outdated systems, whether it's in buying GPUs, edge devices, secure cloud environments, and just getting the data ready and the relevant solutions and skilling of workforce. Now, when asked about confidence, the level of confidence in keeping pace with the developments in AI, adoption, operations of workflow and workforce, you can actually see that the level of confidence is actually quite encouraging. Confident, we are moving in with the right pace. That is about 45% of the CEOs covered in Africa. We are cautiously optimistic, another 32%. And there's, of course, you will see that there is some on the extremes who are highly confident, about just under 10% in Africa, highly confident. And then there's a group that is somewhat uncertain, that are yet to start to focus on these changes. A number of other questions in terms of the readiness of those that are charged with governance and the board in particular. Is your board equipped to navigate the adoption of advanced technologies and strategic use of data, AI to drive business growth within the organization? I think this was actually quite, if you look at global CEOs, 90% of them are saying that their boards are ready there's some work for us to do on the continent, because you see about 59% would agree that we are ready, and there's another 21% who would say we are not ready, our boards are not ready. So there's some work for us to do, some catch up on that front. What we see as the top benefits, implementing AI across the organization, of course, enhanced decision making, right at the top. Efficiency and productivity, again, major benefit, but also it ties directly to profitability. Because of course, better decisions result in better business decisions and growth. Efficiencies and productivity, essentially you're able to reduce the level of cost and then ultimately increase in profitability, amongst other benefits. We see a lot of usage of AI systems and tools in fraud detection, particularly in the financial services sector. And also we're seeing even new products coming on board. In terms of the challenges, what are some of the challenges that our CEOs are citing as affecting their ability to implement AI? Ethical challenges remain top of mind, with 63% of CEOs are saying this is an issue. And this is not just within the private sector, but even more importantly within the public sector. Data readiness, even as I speak to clients across the region, the readiness in terms of quality, availability, accessibility of the data, to what extent it is structured enough to be utilized for purposes of learning, relearning, and modeling is a major issue for most leaders. And then, of course, the time to implement. It takes time to implement, yet the speed and level of change is massive. A few other statements in terms of perspectives on regulation. And you'll see that there's a yearning across the board for more regulation. So CEOs saying the lack of current regulations and direction from generative AI within the industry will be a barrier to organization success. But even more importantly, you see CEOs saying that regulations regarding AI should be increased, and more so because of the dangers of uncontrolled and ungoverned implementation of AI. So that remains a topical issue, both locally in Africa, but we can also see it coming through with global chief executives. How much impact will agentic AI have on the organization? And you can see the majority of respondents are speaking about either significant or moderate. And in fact, we will see a world in our lifetimes where your colleagues are actually agents, not just humans. And the question then is, how do we manage and govern in that kind of environment where a lot of tasks, a lot of responsibilities are being undertaken by agents? And increasingly, we are already starting to see this in many organizations. So that is something to think about on how you will respond and how you will structure and redesign roles, responsibilities, and equipping workforce to be ready for that change. The risks affecting AI and cybersecurity, of course, remains topical. So as organizations, of course, deploy AI, there's large volumes of sensitive data that are being processed. So effectively, the boundaries between data privacy, cybersecurity, model integrity become blurred. And the question then is, how do you engender a trusted environment? So trust cannot necessarily just purely, you can't necessarily just purely focus on performance and innovation, but you got to ensure that as we implement these systems, as we adopt them, we do so with security in mind by design, not as an afterthought because obviously of the implications of cyber. And there are existing trusted AI frameworks that we see organizations implementing. At KPMG, we have a trusted framework on implementation of AI. If you have an interest in that, we can have a conversation separately on how we can make that available to you. Let's turn to talent. And of course, as the AI reshapes industries globally, CEOs essentially face a pivotal moment, which is centered on talent. How do you align tech and talent? What kind of skills do you need? How is the environment being transformed, and how do we respond? And effectively, the future effectively will belong to those who prepare their people, not just implementing the technology. And you can see here, many CEOs are speaking about the need to communicate openly with employees about the potential impact of AI. You can also see CEOs saying that they are engaging with external AI experts to help adoption, but even tailoring AI training to ensure inclusivity across different generations within the workforce. And I think this question about generations is an important one, because many of us tend to think that we need to focus on the younger generation. But the reality of the matter is, because you've got to have human in the middle, the technology cannot just work on its own. The older workforce, the mature employees, have got the experience and the knowledge, and they will be able to determine whether the results that come out of these AI models are actually valid, because you need to validate them. Who is assuring it? So you need a level of experience to be able to really deploy AI productively within the organization. Yes, the youngsters will be the techies, but in actual usage, the elder generation becomes even more important in terms of how we skill them and get them ready for this new environment. How is the organization workforce strategy changing? When we pose this question, we see Africa CEOs rethinking how they attract, develop, and retain talent in this age of AI. And in fact, on screen, you will see many CEOs saying that we are redesigning roles and career paths to reflect AI collaboration. We are focusing on retaining and retraining high potential. We are hiring new talent with AI and tech capabilities. We are currently redeploying staff from traditional roles to AI-enabled roles. So it is not a trend that can be ignored by any organization across the board. In your view, what is the biggest challenge for your organization that is facing in attracting and retaining talent? And there's a myriad of challenges. Across Africa, of course, we can see competition with the tech giants. That is one of the challenges that many of the organizations are facing, bridging the gap between existing skills and desired capabilities. And perhaps this is the biggest. In fact, when you look at global CEOs, 3 out of 10 see that as their biggest challenge. Identifying candidates with suitable technical and collaborative skills. I am sure many of us are grappling with that in our own organizations. Amongst a range of other challenges that we all face and will need to deal with. Now, I know we've asked this question since COVID. What is the expected working environment for your corporate employees? And you can now see about 72% across Africa will expect that over the course of the next 3 years, employees are working in office at least 3 days a week or full time. And about another quarter or so still maintain remote working almost on a holistic basis. And I think this is now totally redefined how we'll continue to work. I think over time we will start to adjust this question, because it's going to say, so what kind of environment do you see in terms of the the integration between agentic AI, where you have agents who are doing a lot of these tasks, vis-a-vis humans, and working collaboratively to deliver. So that hybrid workforce, are you preparing for it, and how, if so, are you getting yourself ready for that future? Now, I think this question on aging workforce is perhaps less relevant in Africa, given our youth dividend. And effectively, while it is a big concern for global CEOs, our young workforce may provide a bit of a buffer, more time for us to plan and build a future-ready workforce. So that's really a benefit being in Africa, but also a great opportunity for us. Lastly, on talent, what is the largest factors that impact your company? And you can see as AI adoption is growing, CEOs are now focused on preparing people, not just the systems for the future, and understanding that growth will depend on how quickly organizations build the right skills, support learning, and foster cultures that adapt with agility. A few comments on ESG, and Ignatius alluded to some of the important messages that are coming here. So we're seeing that while the attitudes towards ESG are changing, and particularly because of the Trump effect, it is actually quite interesting to see that the KPMG CEO Outlook indicates that most CEOs remain strongly committed to navigating this regulatory landscape. And in fact, you can actually see that CEOs are saying we are prioritizing compliance and reporting, obviously because of regulatory standards. They are aligning sustainability goals with their core business strategy. And I think this is the message that both Benson and Ignatius emphasized. And you can also see that there is a small group of CEOs who have remained, we have remained fully committed to our sustainability goals. You can actually see 30% of Africa CEOs saying that, which is quite encouraging to see that response. How confident are you in your organization's ability to navigate regulatory and political differences? In spite of all the noise around ESG and sustainability, the great majority of CEOs are confident that they can navigate the noise around ESG. Now, here is some statements that CEOs have made, which I think would resonate with many of us in the room. So as confidence and trust in governments decline, the public is looking for businesses to fill the void on societal challenges, such as inclusion, equity, climate change, and social justice. There's a role for leaders to fulfill. You'll see many CEOs saying that they have the capability and capacity required to meet reporting standards. But you also see CEOs, 64%, saying successfully addressing sustainability issues is important to the longevity of our business, in spite of the public debate that may detract from the ability to focus on what matters. To what extent does the organization incorporate cost and value of sustainability initiatives when making capital allocation decisions? And again, this is quite instructive. You'll see about 30% saying that they consider the cost and potential return on investment of sustainability initiatives in some capital decisions. Of course, not all, in some capital decisions. You'll also see Another about 1/3 say we comprehensively calculate and integrate both cost and potential return on investments of sustainability initiatives into every major capital decisions. So it's part and core to the sustainability and capital allocation. And we can see that trend increasing. Now, a couple of other comments here on that are being made by CEOs, which again are instructive and will be a good guide that we need to continue to bear in mind. Reducing emissions and improving energy efficiency is a focus for many business leaders. Enhancing climate risk is a major focus, and improving sustainability related data quality and reporting. Energy transition, which has been a major topic over the course of the last few years. What are CEOs' perspectives on this? We are engaging with regulators. You can see CEOs say that. We are focusing on collaboration and partnerships, and we are actively developing and launching new products and solutions. So ESG remained at the core in spite of the noise that we hear, particularly out of politics and related. A few more comments from CEOs. Organizations should help ease the cost of living crisis for customers to safeguard future economic growth. 77% of CEOs in Africa agreeing with that statement. Another one, as a CEO, I will be increasingly required to balance centralized versus local or regional approaches to address impact on issues such as growing political conflict. So we got to remain attuned with what's happening in ESG relative to the geopolitics and related. And with that, those were the key themes. So centering on economic outlook, tech and AI, talent in the context of the changing dynamics and environment, and lastly, ESG. I now want to transition to the next part of the discussion. And I would like to invite a few individuals on stage. Let me start with Martin. Martin is the CEO of Sasini. He's got over 30 years of experience, and he has had the opportunity to work across the continent in various roles in different organizations. So Martin, please welcome on stage. I'd also like to invite Matthew. And Matthew is the Director of Asset and Wealth Management at the Corporate Affairs at the Capital Markets Authority. And Matthew will be speaking to us on elements around regulatory and other matters. And then lastly, I'd like to invite back on stage Ignatius. Ignatius, with your many years of experience in the profession as a regulator and in industry, we're also looking forward to some insights from yourself. Is it working? It's working. Okay. So let me start with it doesn't work for this website. Let me start with Matthew. So Matthew, as we've seen from the survey, businesses continue to grapple with geopolitical disruptions and economic uncertainty. Despite generally low confidence in the global economy, we see 79% of Africa's CEOs remaining very optimistic about the prospects of their own organizations and industry growth. Given your insights into how these challenges are affecting businesses and investments, Why do you think Africa CEOs remain so optimistic?
Yeah, thank you so much. Allow me, before I respond, to pass apologies from my CEO, FCP Outlook Shamia, who was to attend, but he's in another engagement. So I'm representing my CEO from the Capital Markets Authority. I hear you, and you have mentioned the aspect of geopolitics and economic uncertainty that comes with that. I'll answer this more from what you are seeing from the capital market space. I think the CEOs remain optimistic more because of structural resilience in those businesses they are running. They are seeing a niche. And also, as you have mentioned, that we have a young population, then matters technology, matters AI, they really blend with them. If you just check, the median age of Africa is around 19 years. The other place that follows Africa is Pakistan, around 23, 24. Yeah. So with that kind of demographic advantages, then you find that the CEOs are optimistic. I would say that now we just in the region, Tanzania coming from an election. With what you see that is happening, it is something that has happened in Kenya, Uganda, so it's almost repetitive. So let me just be crude and say that uncertainty is predictive in itself. And so businesses have looked at that and they factor in that, including of course, the geopolitics tensions. But I think they are optimistic because there is a bit, because you see the tensions between US and China a bit eased. You've seen kind of calmness around Gaza, the Ukraine-Russia war, after Trump being elected, trying to manage that. So I think they are riding on that aspect of the temperatures have come a bit down, and that's why they are optimistic. Now, closer home, if you look at our capital markets, the market capitalization of NSE in the last 1 year alone has gone up by over Kenya shillings 1 trillion. And that more pointing towards investor confidence that money is coming back to the market. But when we look at our statistics, not only in East Africa and particularly Kenya, but across Africa and indeed across the world, we have seen equities markets picking up. And on the other side, interest rate side, there's stabilization. And I think those are good avenues for investment. If I look at your report, you talked about mergers and acquisition. Again, that is also driving that positive outlook. The businesses want to diversify rather than stay in one place. And so if you look at the capital markets, from the traditional bond and equities, the market has gone into exchange traded funds. Right now we have 2 listed. The latest was just this year. It's had to ETF from SA that is benchmarking on global MSI index. We've seen products around rates. For example, in the retail market, collective investment schemes are also growing. 7 years ago, our total asset under management was around 56 billion shillings. Now we are over $500 billion in just less than 10 years. So the diversification of the product offering, I think, is also pointing towards innovation that is speaking to this positive outlook. Yeah.
Thank you. And Abidja, let's just make sure we have a roving mic. I'd like to ask for some commentary from the floor, particularly from some of our CEOs. And in fact, I'd like to maybe just ask Jane Karuku, given the industry that you run and the level of optimism that we see from the report, effectively, you're almost a barometer of the growth and the prospects and outlook in the economy. Is that being felt on the ground?
Thank you, Gerard, for the ambush. I think calling us a barometer, I'm not so sure. But I think what I can say there is optimism. We know our region, Africa, it's a high margin business. We have the youth dividend. We are still trying to explore in a lot of things. But equally, we have very many risks. Who would have thought our neighbors in Tanzania would have turned out the way it did? So I think still very, very risky place. But having said that, we are seeing instruments. I mean, we're just chatting with my friend there from CMA. We've gone to the market. And since we are public, I can tell you it's already been oversubscribed. For those who don't know, we're having an MTN. We are raising money from the public and we want 20 billion. I don't think we'll have a problem indexing that times two. So it shows that either it's the confidence of FMCG or EBL, or there's a lot of cash starting to come back because of the global shocks. We still can't figure it out. Even in terms of NSC capitalization, I still have to figure out where are the share prices in Kenya going up? Yet there are so many other questions around our ecosystem, isn't it? I think we don't know the answer, and maybe that's where AI comes in. Maybe we can aggregate all those comments that happen behind the scenes and try to decipher what exactly is going on. But I think the other challenge we are seeing, the top line, macros, GDP, NSC, inflation, fantastic. When you come below the rate, below a certain threshold, there's a serious challenge on consumer discretionary spend. And our business is on discretionary spend, so consumers are hurting. So you have what I call a very bad hourglass in business, an ugly hourglass, where the top is very vibrant and growing very well. The middle is shrinking very, very fast, and they're dropping to the bottom. So a bad shipped 8, which is not good for sustainability of the business. So I think we need to be careful when we talk about optimism. I was looking at your data, but you can see CEOs are saying everything is a priority, particularly from Africa. From AI to
talent.
I don't know, everything was in 40 and above or 50 plus, which is a challenge, I guess. So I think, Gerard, I'm throwing this question back to you. That sitting here, I hope, and I'm not the only one who wants to understand what exactly is going on. Great statistics, bad hourglass, depressed consumer confidence, because this is CEO's confidence. From a consumer confidence, there is pressure. I don't know whether I've answered.
I mean, different perspectives. There's going to be different perspectives from different industries, and I think that's really useful. I will ask one of the bank CEOs in the room, and I'll just speak without necessarily warning you. So just prepare for one or more of the questions coming through. Let's turn our attention a little to ESG, and this question goes to both Martin and Ignatius. And despite the current challenges affecting ESG positioning and implementation, almost half of Africa and global CEOs are aligning sustainability goals to their core business strategy to demonstrate value to their stakeholders. They are also prioritizing compliance and reporting standards to meet investor and regulatory demands. Just about 10% have decreased their sustainability initiatives to balance other business priorities. So the question is this: what could be informing the CEO's decisions to hold on to ESG despite the criticism and challenges that we are witnessing globally?
Yeah, that's a good question. Before I answer that, maybe let's throw a challenge to KPMG. This room is not representative of our society. The panel is actually grossly wrong, if you ask me. We should have female voices more represented in these things. And I say that it's good to hear Jane talking and giving her perspective, because we need to be deliberate about some of these things, especially when we're talking about ESG. That deliberation comes from leadership. It comes from optics. Optics may be peripheral, but they matter. And I'll link this to answering your question. When optics show the right statistics, you start to get results down the organizations that you look for. And female representation in aspects of leading business has become so critical that if it's not being seen at this kind of fora, there's a problem. So we just need, that's just a small little detail I noticed when I walked into the room. African CEOs are more focused on driving ESG, despite the noise we are seeing from the global West specifically, but also generally from the global North, because we know that our reliance on those two regions is dwindling. We do not need them to keep giving us guidance on what we need to do with our own businesses on the continent. And as we've heard from the leaders of KPMG, we are charting our own path. And we are seeing a lot of us coming together to start saying what is critical for our businesses in the continent does not necessarily need to come from the global North. In fact, the answers that we've gotten from the global North, both in the public space and in the private space, have not worked for us. So why do we continue looking to the global North or the global West to give us these answers? So we generate 2% of what causes global warming in the continent. Yet 40% of the effects of global warming is felt in the continent. It's not our fault. So if we sit here and wait for the global North to give us funding to deal with climate adaptation and change, we're not going to get that. The Paris Accord was signed in 2015. The US, which is the biggest abuser of this, has removed itself from that accord. Where are we expecting these funds to come from? This continent can transition into solar energy, for example, without spending anything. Why do we keep going abroad to borrow money to do things we know are critical for our societies? And that's why you're seeing that reflected in that. There's so many African CEOs who are coming to the realization, the global North and the global West is a hoax. Let's do our own thing. And to talk to Trump specifically, because somebody mentioned him earlier, I mean, he's doing what's right for his country. We must do what's right for ours. And so if we then look to align ourselves and respond to the fact that the US is being protectionist, what interest does that leave us with? So we really need to be bold in saying our solutions need to come from within.
I think let me first respond to the challenge. We do acknowledge the challenge, and to a point that from the KPMG point of view, not only in the continent, but globally, we actually do have targets that we're working towards to change this kind of makeup, because that's one of the issues that we recognized, and it's quite important to us. But secondly, when I move on to why we carry on as Africa CEOs as far as ESG is concerned. My sister there has mentioned the hourglass with the middle shrinking and dropping to the bottom. You know, we have this confidence that we say, as this is a CEO survey, where in the hourglass do the CEOs sit? At the top. And therefore, our future is bright. But what about the people that actually sustain us, which is our customers? If they drop more and more to the bottom, we are in danger. And I think the CEO realized that. And that is why there is no way that we can carry on as business as usual without integrating, as we said earlier, ESG into our core strategy to ensure that we uplift that bottom and bring it to the top. The climate change, it's one thing and it's important and it's affecting us, but the S in the ESG is actually just as important. And that is why uplifting our people in the continent, that is why caring about unemployment, that is why caring about retraining and re-educating people to bring them into the digital dividend, that is not only for the CEOs, but for everybody, is very key. And that is why it's also important to talk to our governments to ensure that the governments also transcend. You will notice that our survey this time was not country-based, but it's more continent and regionally based, because our CEOs think in Pan-Africanist way. At the very least, think regionally, not country. That is something that actually gives growth and prosperity to our companies, and that's why we have more confidence in the prospects of our companies, because we're looking at least regionally, but more continentally. How many governments, how many of our country governments are really thinking regionally or African-wide? We are obsessed as governments in looking after our cabbage patch instead of looking at the Garden of Eden. Because if you look at the Garden of Eden and you ignore your cabbage patch, you are threatening what people call sovereignty, what people call authority, which actually has no real tangible benefits. Other competitors have actually regionalized a lot more than what we have. In actual fact, as governments, we have regionalized pretty little. And that's what I also meant earlier to say, let's take our governments with. If we are to uplift our communities, we need to be working more as regional powerhouses and developing people, and stop fighting over useless borders that were never drawn by us in the first place. Let's concentrate on uplifting our people regardless of where they are, and stop trying to manage the movement of people. Just manage the development of people, ensuring that they rise above to the higher part of the hourglass, regardless of where in the continent they're sitting. And business is seeing that and is beginning to do that. And my plea is, let's take our governments with.
Thank you, Ignatius. I'm going to shift gears a little and talk technology now a little, which has got a big bearing, particularly with the financial services industry. This question will go to Kihara. I think that we're seeing increasing investment in technology. And most of the leaders that we surveyed expressed strong confidence in their board's capacity to manage AI integration within the organization. Almost all CEOs recognize that ethical challenges continue to complicate the implementation of AI. Given the widespread acknowledgement of the ethical challenges, what specific steps are you seeing within your own organization and across the industry to ensure responsible and ethical AI adoption?
Thank you, Gerald, and thank you to KPMG for gathering us together to unpack these insights that you've gathered from the CEO survey. I think this must be the second year running that this is quite topical, and in our understanding of this space at I&M, we've also been doing a lot of learning. And just last week at a strategy retreat in Uganda, we had a leading AI expert tell us, actually, this is really not new. This has been going on. It's a journey that we've been on really since the 50s, right? What has really improved is the access to technology, the speed of processing, and the extent of data that we have. So I think it's clear this is an evolution. What we've always understood is that all our businesses, regardless of which industry we are in, we make money from information. And it is critical, therefore, that we appreciate what data means to us and how, with the better tools that we now have, we can actually get insights a lot faster. Now, coming to the issue of ethical and responsible use of technology, we have seen abuses over time. And I think some of that was covered in the report. And as organizations, we have to really think about how we make sure that our businesses remain sustainable from the perspective of the data that we have about our customers. I think in terms of who takes the lead, we have seen regulatory authorities around the continent, in particular here, where we work, really starting to put in place different sorts of organs and laws to make sure that we are actually protecting the data of consumers. We're using data responsibly. Now, a lot of it is more compliance driven. And, you know, we've seen some organizations facing mind-boggling, fines that are likely in the courts because of data breaches that have happened. That, yes, does get to scare us, but we really shouldn't be driven by fear when thinking about this. We really should be thinking about it from an ethical perspective and saying, how do we actually make sure that we're using data responsibly and protecting customers' data responsibly? So to that end, we have to think about it from several perspectives. Number one is governance. We have to have proper governance frameworks within the organization. That means that for that to happen well, you have to train people throughout the organization to understand how to use data responsibly. That means beginning with your board. It was interesting to see the readiness that CEOs express their boards have in managing an area. And you talked about the generational issues that we have within organizations. Boards tend to have more senior makeup in their boards, and understanding some of these technological advancements might not necessarily be as well understood. They do understand the need for responsibility within the organization in managing the impact of things like data breaches and so on, but I'm not so sure that they are that ready when it comes to understanding the technology. Nevertheless, the important thing is to make sure that you are actually starting with knowledge, right? You're empowering people who are making decisions for the organization to understand what is it that we need to do, why are we investing in this particular area, and what kind of challenges, what risks are we facing. Now, that knowledge should then cover, of course, when it comes to ethical and responsible AI, in particular, it should cover things that are coming to us because some of these technologies are actually coming from other markets, right? So, for example, we have to appreciate that a lot of large language models, for example, are being trained on data sets that are not necessarily data sets from here in Africa, right? We have to think about the biases that then exist because of things like those. So if you're training it on, facial recognition and it's coming from a Caucasian face in the US, it might not necessarily immediately pick up if you're using it as part of your security systems in our context. So it is important that we are clear about how to make sure that we are watching carefully about the kind of biases that we may get through adopting some of this technology. We also have to think about how we put human guardrails in the process. Technology is meant to really multiply the productivity of human beings. We are supposed to therefore be careful that we are not ceding decisions just simply to technology. In the bank, you talked about the financial services industry, and here we live with practical examples. We are already using this in our decision making, for example, in credit decisioning. We have to therefore be careful that we are putting in the human guardrails that ensure that you have empathy in your decisions, that you can also explain how you made your decisions, right? So you must have explainability in your modeling, right? And that is important to build into your governance structure. So there are many things I think that we can look at as ethical challenges that come into this. We have to be deliberate about how we solve for these issues. We have to think about how we engage with regulators and other people who are then overseeing what we're doing, to make sure that they also understand the challenges that we are facing, and it's not simply a big stick that's coming out. It's something that we are clear we are working together to just ensure that this is done sustainably. So let me pause there.
No, absolutely, and then they're very useful and practical insights, which I believe will resonate with most of the participants in the room. Before I come back to my panel, I also want to pose another question to one of our other CEOs in the room, Murali. Where's Murali? Murali, there you are. So we'll turn a little to data privacy, security, integrity of models, and so on. So cyber security and digital risk resilience, AI integration into operations and workflow, and investing in solutions and technology as we innovate and expand has been top investment areas, as we have seen in the report. What are some of your perspectives in terms of how we manage the risks relating to cyber, data privacy, and some of the other challenges we see in that regard within your own organization, but also across the banking industry?
Good morning, and thank you for inviting us to the thought-provoking session. Grateful to KPMG for this invitation. So I will break this question into two parts. Cybersecurity, I believe, is slightly easier to deal with. To me, it is one of the scariest part of my job. If you're working in a bank, cybersecurity threat is very real. And I'll tell you the kind of investments that I see in the last, say, 10, 15 years. Our cybersecurity department has got now 40 odd people, 24 hours, monitoring transactions. And the same unit would have been just about 5 people, maybe 10, 12 years ago. The number of software that we are using to monitor and prevent attacks would run into dozens. The challenge for CEOs in cybersecurity is, according to me, two. Number one is that when the cyber security expert comes and makes a proposal saying that we need to upgrade or introduce a new technology or put this system, you can never ask what is the cost benefit, because the threat is like unlimited. The maximum question that you can ask is that, are there alternatives which are better, cheaper? And the second part is that, especially in a service industry that we come from, the last mile is always the human being. So despite all that you have, all the investment that has happened, you are many times dependent on the last mile action by an employee. And you can do a lot of survey. You will find that many times the compromise has happened because of a human being either not following a process or deliberately doing something. So to me, while the cost of technology on cybersecurity is still becoming cheaper maybe, but the number of threats and the challenges because of the complexity of the whole environment, channels, systems, what have you, is very real. So as an example, the first question I always ask whenever a system does not behave is that, is there a cyber attack? Yesterday, for example, a jump server misbehaved for about a few minutes and customer service was disrupted. The first question I asked was, have you ruled out cyber threat? And unless and until you get past that, you can't, because you never know. So one of the cyber security experts told me, always understand that cyber security, the question is when, not if. So that is my perspective on cyber security. As far as AI is concerned, I've been in banking for now 40 years. The first time that I got introduced to AI was by a very bright software engineer way back in 1991 when I was working in Citibank. And he explained to me what is artificial intelligence and machine learning. And I was fascinated. I was in operations those days. And I convinced my boss to say that we need to use him for some application in our bank. Unfortunately, we didn't get too much of sponsors, but still, that small project that we did helped me understand right at the early stage as to what is the potential of AI. But things have come a very, very long way. I wish I had invested in some of the AI companies which have done very well in the stock exchange. But in our bank, we are focusing on 3 areas in AI. Number 1, customer service. Number 2, fraud monitoring. And number 3, anti-money laundering. The reason why we are doing in 3 areas is because A, in customer service, it helps you to target and present a much sharper proposal and offer to the customers. In fraud controls and AML, that is anti-money laundering, it helps you to remove a lot of false positives, which unnecessarily sucks up resources, which can be put to a much better use. So my own perspective, I would give ourselves marks just 2 out of 10 of the progress that we've made on AI so far. But the potential obviously is very high, and it is scary and exciting at the same time. Those are my thoughts on the 2 topics.
Morale, thank you very much. Again, some very useful use cases, which I'm sure will also be replicable in many of the organizations represented. Talking about Citibank, I realize the Citibank MD is in the room. Martin, any perspective you wish to share in relation to how you are upskilling your employees in this context of the changing tech and AI environment?
Thank you, Gerald, and thank you for inviting us to this wonderful session and sitting me next to my customer here. So as we respond to your ambushes, we can also talk business. I really want to, first of all, commend that response by Ignatius in terms of looking at upskilling and letting everyone rise to the top, irrespective of where they are in the continent, not focusing on, restricting movement, but looking at the forest. It's a fantastic response. Thank you for that. And, for us at Citi, when we look at, just coming to your question, Gerald, how we are transitioning to the new environment, looking at AI as an accelerator, front and center in that approach is the ethical use of AI, right? Upskilling, of course, is critical. And there's a lot of conversation and fear whether AI will actually replace or will complement skills. And I think the focus for us as leadership, as CEOs, is first and foremost to communicate to our people that AI will actually improve productivity and also complement what they already do today. So Citi, with almost 230,000 employees globally, is again having this AI conversation. We have rolled out a number of Gen AI tools, and we're also now moving to agentic AI use cases, not because it's just a Citi imperative, but our clients are also expecting us to be able to communicate with them, engage with them, using different AI tools, particularly agentic AI tools, right? So let me start with a couple of use cases in terms of what we are doing. We've adopted the Gen AI tools that allows for productivity gains. Yeah, whether this is analyzing documents, preparing summaries, and enabling us to be quite active in how we engage day to day. Another use case is that in the coding area, development of code, we're using AI capabilities to drive coding, and that is having a lot of impact in terms of productivity. Use cases around sanction screening in our global payments platforms, in our risk analytics, in also just understanding the various documents that we have in the organization that require different types of analysis. And most importantly, in our payment flows and looking at threats, the Citi moves about $5 trillion a day globally. And that type of high velocity payment requires high velocity screening and high velocity tools. And that's where AI has come into play. So we are already applying use cases of AI. And where we think this is going is that we see AI move into the agentic phase where customers will engage with us through AI tools. Okay, so whether it's chatbots, or customer service use cases, that phase of AI development is coming, and it's not coming in the near future. It's coming within the next 6 to 12 months. So for financial services today, and there are a couple of CEOs in the room, and my colleagues have spoken, the highest adoption of AI has actually been in telecommunications, and then secondly, financial services. For safety, for processing, for analytics, and for driving resilience in organizations. I think financial services essentially do not have a choice.
Yeah.
They have to all get onto this boat, and whether your business model is retail, or it's very digital driven or very corporate centric, AI now is something that financial services are all investing in. So to close, what I do want to leave you with is that AI is not something we should approach with trepidation or fear. One, we need to communicate to our people that we lead. Two, it's our responsibility to upskill not just the bottom of the pyramid, but also the leaderships and the board. And then three, contribute to the national direction towards AI. Kenya already has a national AI policy, and we can all be voices towards supporting that policy. So thank you.
Very, very succinct. And again, I think just to demystify the whole area of AI, because most might tend to think, but how does it impact me? How does it? So that was really, really practical. I'm going to change gears a bit. So I'll come to you, Jane, and then I'll go to Ignatius, and we'll work our way towards the left. We'll talk about talent for a moment. So we've seen from the report the CEOs acknowledging concerns around AI adoption. To respond to these concerns, they are communicating openly with employees about the potential impact on AI roles, providing AI education and training across the workforce, investing in skilling, upskilling, changing roles, and so on. Now, using your own industry example, how is AI impacting your workforce And are you seeing redesigning of roles and career paths that reflect AI collaboration?
Thank you, Gerard. I think AI has been with us longer than we would like to accept. So I think in our business, we are very consumer facing. So we've used AI for the last 20 years in driving analytics, in listening to the customer, not eavesdropping, but looking at what is going on within the consumer space and using that to predict what might happen, and also backwards what happened, and trying to decipher what exactly is going on. So we're using it on in market research. We also use it in advertising. So the other day, somebody told me, if you go to Google and these things keep popping to you, it's AI. So I think we buy that technology from either Meta, Google, to help us target better in advertising. And then the last one is within the operations, we also use a lot of AI. So we're using AI across from manufacturing, from making, from buying, all the way to the consumer in analytics and driving efficiency. So that's one. So therefore, it means from an organization perspective is we have to hire right. So internally, about a few years ago, we started hiring the digital, we call them a digital tribe. These are very young, call them things, because sometimes they look like things. They are young people, average age 21, very agile and very digital, and who really understand AI and want more. So they are demanding of the organization a culture change so that we can be more techy, more AI driven, and also helping us because they understand faster, helping us in building the capability within the organization. And then for the rest of the organization, the core, those of us you're calling old or not so young, we have to be trained. So there's a lot of training taking place in the organization, particularly in the cyberspace. So cyber mandatory training on an ongoing basis. And kind of, I call it testing all the time, whether people are aware, response rate and how we react. We are testing that. So, and that is also in some more serious capability building. And then if you're in the cost space of tech, it's serious now capability building.
Yeah.
Serious. And then we're also seeing demand from the board. So in fact, just next week, we'll have a full day training on AI of the board, because we need to make sure we're understanding the same language. So I think the biggest one is hire the right talents who are more agile and who probably are miles ahead in this space, and then keep training, keep investing. It's quite expensive because you have to change certain ways, processes, and capability within the ecosystem, and then make sure the whole pyramid from board to the lowest level of the person is trained, but also using it. So a lot of us in our gizmos, I don't think we write emails anymore, isn't it? Somebody helps us write emails.
Copilot.
Copiloting. So if you use it every day, it just becomes a nice thing. But being aware also, it is, I think it's AI is equally good and equally risky. So just making sure that you have some people thinking all the time in the organization how to manage both, because it can be very bad or very good.
Yeah.
Thank you.
Thank you, Jane. Thank you, Jane. And maybe Ignatius, if you could develop those thoughts. You run a people organization. You don't manufacture any goods. So how is KPMG responding, and how is the profession responding?
Thanks for that, Gerard. You see, part of the question there says open and transparent communication to your people. There clearly is a concern among our people that there's going to be loss of jobs. Now, our industries are different, and our approach to AI is different. And if in your honest assessment, there will be job losses, I think you need to be transparent about it. Now, in our case, and it differs, even in the industry, it differs from company to company. In our own assessment, we do not see job losses happening in our organization. What we do see is the change in the skills that are needed to do your job. And if you go on our intranet, our people know there are tons of online courses on reskilling get towards the products that we have. They're done online. They're also normal classroom situation training for reskilling. We're also complementing that clearly with going into the market, as Jane has said, to get people that are that way inclined and maybe even slightly ahead of the curve to fuel the momentum of reskilling that's happening within the organization. That is reskilling. What we are very open about, and we've got some of our people here, they've heard me say this, those that are not embracing the reskilling, then if you're in that situation, your job is at risk. Because those people that embrace and use AI will continue in their jobs, but those that do not embrace are going to be replaced by people that embrace and train and get expertise in AI. And you've got to be open and honest about that. And that's why earlier, because we also subscribe to that, entry-level jobs we are re-looking at. Not with the view of getting rid of people that are doing entry-level jobs, but reskilling them to actually do jobs at a higher level because they would then be using the AI. I mean, Jane spoke about analytical reviews. Most of us in whatever company we are, we do a lot of analytics. Now, if you think about 10 years ago, those analytics, I mean, even in our industry, you needed an entry-level clerk that did all the numbers and did on Excel, and then you see the trends and you analyze. You are doing it yourself. And then you give to your senior to actually interpret. Now, we're not going to be actually doing the analytical work because the products or our AI will do that. And where you come in is actually interpreting what these analytics are telling you and where action should be taken. Now, I must also move a bit and talk about as we use AI, our clients. I'm always fascinated because we build our AI products, for instance, into our audit work process and into our advisory work process, tax processes. And when you say to a client, when we audit your revenue, we no longer going to be doing a sample. We will actually audit all of your revenue. No longer sample, but everything. And by the way, in the olden days when we did that, on the sample basis, it used to take us 3 weeks. Now, when we do 100% of the population, it's going to take us an hour. And I'm sure I'm talking to the converted because you've had those discussions. And what is the first question you ask us? Well, if you're going to do it in an hour, exactly. Oh, now I'm going to save on audit fees. Nobody thinks about how much it costs us to do that. To be able to develop that product that enables us to do 100% of the audit of your population in revenue in an hour, how much have we spent to be able to get to that point? Nobody thinks about that. So you shouldn't pay for that, eh? And here's another thing. In KPMG, all of our AI products, not only are they bespoke, but they use bespoke data. We only use KPMG data The only other data that we use outside KPMG data is client data. We don't use internet data. Why? You may have seen there's been some popular cases, and I'll cite the one in Australia because it does not include any of our competitors, where a professor from a university produced an AI report that he was presenting to the Australian Parliament about the scandals of the Big Four firms. And it was AI driven, and he never reviewed, never verified. It was all on data from the internet. But 80% of those cases were fabricated, and others that were not fabricated were linked to wrong firms. And they would say, for instance, in the report, KPMG in this particular scandal that involves this particular company did X, Y, Z. And KPMG had never had a client in its life. The scandal does exist, except it was not KPMG. Stuff like that. And now recently, there was also an example where one of the firms was taken to task for a similar thing. And that's why we've decided as KPMG, we can only use, and this is part of ethical use of AI, only bespoke data and only client data. But another thing that I want to appeal to you, as we approach you to try and use your data on AI, a lot of people are still very reticent, outlines. And you say, I'm not too sure that you should be deploying your AI on my data. And therefore, the benefits of all these investments that we're doing do not fully benefit us, you and I, if we are restricted in. I understand the guardrails. Guardrails should be there. You got to be responsible about your data. And you got to get satisfaction from us that your data will still be safe and the integrity of your data will still be safeguarded. That's fine. But we find more and more that CFOs in particular are very reticent and say, no, I'd rather you do it the old-fashioned way. Another thing, and regulators, they also say, well, if I can't re-perform the procedures that you've done, then I don't want you to use it. Well, you can't re-perform it unless you've got exactly the AI product that I have. So what does that mean? Should I give you my AI? Should I train you on it and whatever? And are you going to do that for every person that you regulate? I think we need to take the stakeholders with to have the true benefits of AI. So we still need to have open discussions, not only with our staff, but with you, your clients, and with our regulators as well. Thank you.
Thank you very much, Ignatius. Also re-emphasizing the need for the human in the middle, particularly with the Australian case. Now, I do want to bring this session to a close very shortly. There may be one or two burning questions from the floor as I give my last two participants an opportunity to say a few words. Let's take, there's one right at the back, and then there's another one. Yes, you may go first.
Yeah, thank you so much,
Maybe you can
Gerald, and
introduce
good
yourself
morning.
as you speak. Yep.
Thank you and good morning, Gerald. My name is Jojo Diambo, the MD for National Bank of Kenya, subsidiary of Access Bank PLC. We do operate businesses in 16 African countries and 8 out of Africa. So what I'm hearing here is basically in different format, what the discussions in different boards are having in the organization as a group, responsible and ethical implementation. And one of the issues coming up in the board meeting is how do we then take care that biases are not inbuilt into AI models that are sustained for inordinate periods. These biases could arise from the wrong data set that are used then to inform the future decision, because we are big on decision analytics and predictive analysis also. So the bias is the big question. Then the second comment is that whenever we have this discussion on the board, the last question would be, how much would it cost us? At management, we are not very clear. Experts are not very clear. Is there any mechanism to be able to be responding to what would it cost an organization that has 30,000 employees, 24 countries, different jurisdictions? Thank you.
Yeah, I think on the first comment that you made, Kihara really touched on that in his commentary. On the second one, on how much it's going to cost, no one knows. How long is a piece of string? And that's why you see organizations are setting aside on an annual basis up to about 20%, the majority of CEOs, in investing in AI, because it's so topical, everybody recognizes it's going to take time and is going to impact the organization. Obviously, it depends on your implementation plan and strategy. You're going to have to prioritize. You're going to have to start with certain core processes, and over time, you'll work through others. But the reality of the matter is the investment has got to start now, given the realities of the constraints that you may be faced as an organization and the available resources. I'd allow an opportunity for maybe one of the CEOs to respond to it as we take a second question or comment. Kihara, just give Kihara the mic. Please ask your question.
All right, good morning, everyone. Jimmy Mbogo from Citizen TV. And Gerald, so during your presentation, one of the things that actually came out is the fact that African CEOs are looking at mergers and acquisition. Could you share more details on that? And are they looking at regional acquisition and mergers, and what sectors are they in?
Okay, that is an interesting, and I'll have to pass it on to one of the bankers. Kihara, do you want to respond to the question?
Respond to George's question, and it's really just to put a bit a spin on the cost question, because I think the AI frameworks you can actually adopt. There are several that have been very well developed by, including firms like KPMG. But you know, the cost of adoption of technology tends to follow a curve, right? You will get your early adopters, and there'll be people who are selling you solutions. And because it's early stage, it will obviously have a very big price tag. And of course, as widespread adoption comes in, then you get the price coming down. But the bit that we don't normally look at is the opportunity cost. So if you don't adopt, what's the cost that you're suffering there? You're losing the opportunity to actually acquire customers faster. You're increasing the vulnerability of your organization because you're not protecting yourself faster, and so on. So you need to look at both sides of the question, but you also want to be careful that you're doing it in a structured fashion, so that you're not just simply doing it because it's the shiny new toy in town. You need to have a strategy that's driving your adoption of technology. And like at I&M, we are very particular about also doing it in a sustainable fashion. So for example, we will say that we will adopt AI while thinking about the energy efficiency of the different tools that are actually supporting that AI.
Yeah.
I'm not touching the mergers.
Yeah, the mergers and acquisition one, I think I'll just say is across industry. And in fact, if you follow what has happened in our market and elsewhere, you will see that there's a lot of movement, particularly in the financial services with banks within that industry. There is also focus on some of the fast-moving consumer goods. There is focus in healthcare. But to a large extent, with respect to technology, many joint venturing and partnerships with fintechs, entities that can extend and scale the operations of existing businesses beyond their traditional core. Because many entities recognize that it is really not just about growing organically and multiplying. It's more extending and working with like-minded organizations in joint ventures and partnerships. But I think we can explore that in a little more detail separately. All right, I don't see any other. There's a hand there at the back.
Thank you very much for inviting us for the CEO Outlook. My name is Ashish Sharma. I'm Serena Hotel CEO. I love the discussion about AI. However, in our industry in hospitality, we have to make sure we don't lose the human touch. And as we talk about AI in great magnitude, just remember the word artificial. There's artificial intelligence and there's real intelligence. And as CEO here in Africa, where we are, there are a very large number of talents applying for jobs. And one thing artificial intelligence does injustice to the young talents is every person in this room has a uniqueness about themselves. Everybody has got a story. Now, I recall one of my sons was applying for a job and he did a nice resume in UK. And I said to him, this looks be original, be unique, who you are. And artificial intelligence read that resume, spat it out in 5 minutes, rejected it. And now there are people who know how to beat artificial intelligence job applications. And you have to pay them £1,000 to actually draft your resume for you to beat. So what we are doing also is starting to program people in a particular way. If they don't fit into that criteria squared because the machine is reading you, and then you're interviewed by a machine who watches your body language as you're answering, and that uniqueness starts to disappear. And I think we as CEOs, we have very unique talent in this region. I'm not talking Kenya, I'm talking the whole of Africa. We should not delegate this part when the young people are coming to us for jobs or applying to our human resources, just delegate it to our AI. We must make that point. I'm thinking, yes, AI is a tool we must use, we must embrace it, we must get some benefits out of it, but not lose the originality.
Yeah, I think very important comment that you make there. And I think somebody did make a comment about biases and the data that you use to train these algorithms. And as they learn and relearn, it is not unusual, the example that you've actually just raised. And by the way, it doesn't only apply to job applications. It also has everything to do with what is communicated, what information is sent out in the public domain, what motives the people behind these algorithms want to drive. And to the greatest extent, I mean, we got to understand and accept that these machines, by the way, are going to become far more intelligent than human beings. How do you work in that environment? That is perhaps the scariest aspect of the evolution that we are going through. But a long topic for a longer discussion. I think the point is well made. I think we're running out of time. I do want to ask Martin to make a final comment, followed by Matthew.
Yeah, just a couple of things with regards to mergers and acquisitions. We're very active in that space in the agricultural sector. We see that being driven by two things: acquisition of the need to expand your profit lines or your revenue lines, and the need to expand your scale base or acquiring people that give you skill you don't have. And it's across all industries. I like the point about AI and not over relying on it. What we are seeing in our evolution is AI is not a tool, it's an ecosystem. And so if you look at it that way, the human aspect is integral to its advancement. And so I don't think we should be scared that it's stopping us from employing. In fact, the young generation coming to us for employment are asking us, in Sassini's case specifically, what are you doing in these two areas, in the ESG space and in the AI space? And if you're not showing them that you're active with your artificial intelligent approach and you have a strategy behind them, they're telling us they're not interested. So I think there's a misnomer and a misunderstanding around AI stopping jobs. I agree with Ignatius absolutely 100%. If your organization is not linking AI into what you're doing in terms of people adapting it, those people will become irrelevant. They will lose their jobs. Let's accept that. We worried about ATMs in the 90s. We worried about cell phones in the turn of the millennium. We worried about the internet at the end of the 80s. We are now worrying about AI. These trends have been with us. People have been in jobs all through them. It's just getting bigger and deeper. And those who engulf these technologies will be there forever. Thank you.
Thank you, Martin. And Matthew?
Yeah, thanks. Just a few things. Apart from what you have said on the mergers and acquisition in terms of profit lines, I see it as a way of businesses struggling to survive. When you come together, you build economy scale. You also manage your risk through portfolio diversification. Now, from regulators' perspective, we are seeing a lot of applications on new things. Even some of the traditional licensees, let's say they're in online Forex, once they are there, they come with something else where we don't have a regulation. And I can see that is one of the concerns of the CEOs. So how have we responded? One is that we have a regulatory sandbox where innovators, you can come and test your ideas. Then we see the how to regulate it, or we point to somebody else. And if you're already running with it, let's say the business, we don't stop you. Principle-based oversight, we can issue some guidance, notes on that, as we see what kind of law we need to come up with. We also encourage industry players. Now that we are talking about, we know the day that Baba died, he knows what Baba is. The president signed the virtual assets bill into an act. And the virtual assets and service provider bill, if you look at it, is giving CMA and CBK as regulators. If you use the virtual asset for payment, then CBK comes in. But if you use it as an asset investment, then CMA comes in. So you can see that the business environment, the innovation is moving ahead of regulation, but it doesn't mean that we are not doing something. But the bigger aspect is facilitation. We do benchmark with our global peers, but what we do, we customize. And the beauty is that if you are the first one to come up with it, let's say in Kenya, then you find that when South Africa or another, they come to us. So there's a lot of, discussions among regulators across Africa. So I want to give Ignatius that comfort that we are working together towards a common goal. On data, I happen to also represent my CMA at ISPAC. I can see ISPAC is here. So professional organizations, not just ISPAC, for doctors, for everybody, is bring them in this conversation on data integrity, because we tell them that this data is going to be used to make decisions that have far-reaching effect. Jenny is sitting there. EABL is bringing a 20 billion, corporate bond, bringing a draft. And what she has not told you is that she's raising money at 100 basis points less than what she did 5 years ago. Is that true? So what we are looking at government as we look at the bottom, the middle, is that we urge new businesses to pass on those benefits to the consumers so that we grow that middle and bottom. So we want to have that conversation work together. More than 12 years ago, if you remember, Bitang and Demo was the PS, those were Kenyan. We could not hold this kind of forum without talking about blockchain, right? But if I ask today, how many organizations, I know we have virtual assets coming in, apart from those crypto providers. If you ask how many organizations, even in government, have blockchain, we have been talking about we don't have it. But AI has come with immediate application. So much so that if you go to school for a Parents' Day, pre-primary, the teachers are telling you, please, can you control your gadgets? I give homework, but it's not your child who does it, it's AI. So that is the space that you are in. You have talked about creating more jobs, the CEOs create more jobs. I will say this, the quality of those jobs is one is increasing, disproportionately, because you need all these kind of skills. But the quantity might be lower because with automation and technological advancement, you need less heads. But then as Africa, why don't we look elsewhere? My last point, at CMA, we are not just oversighting capital markets. We are also oversighting structured commodity exchanges, starting with the coffee exchange, where we have worked with Ministry of Agriculture and other government agencies to bring in supply chain efficiencies. I saw supply chain as one of the top line. If you are moving a bag of maize from Trans Nzoia to Nairobi, why should you be charged at every point in all these counties? Then by the time you reach Nairobi, it's very expensive. So even before in Africa, we talk about value addition, and CEO Ignatius talked about exporting our raw products at whatever cost. If we just work even on value chain efficiencies and take that back to the bottom, we'll build that bottom. And that is what government is looking at. Thank you.
Thank you very much. A word of applause. Thank you very much. Martin, really appreciated. Matthew and Ignatius. And of course, the CEOs in the room that have shared your insights and your comments. With that, I think I want to bring the panel session to a close and invite Benson to close.
Thank you very, very much, Gerard, and the panels. A big applause for the panels. And there is a former panel and there was another panel from the audience, both very active. Thank you very much to your CEOs. Greatly appreciated your time and thank you for your patience. I want to bring this to a close from wherever you are. Our gratitude, the information remains available, the insights, our KPMG team from across the Africa continent, wherever country you sit in, have this information. We will have followed through to break it down further. And the document will also be, I believe, by now available to you. Thank you all and hope to see you again soon as we engage. Bye-bye.